I was thinking about a simple way you can think about Lemonade's valuation when they get to a $10 billion valuation in the future. Sort of a simple model, different angle and framework, especially around their operating expenses, that we can look at and could use for more detailed modeling. But you'll get is a quick way to sort of think about Lemonade's potential value in the future. So I posted this a few days ago, just to sort of reiterating, hey, Lemonade's at $800,000 of IFP per employee. But their plan is, this was a slide from their investor day too, is that, hey, they're around 800,000 now, so they're somewhere over, in this area here. Other great insurers, Progressive, Geico, Allstate, Travelers, they listed around $1 million. Uber, Spotify, Netflix, you can see sort of in that, $2 million between there and $2 million or ish per employee. But Lemonade strives or hopes to get to $4 million per employee of IFP at the range where they say where they get to $10 billion, when they scale to $10 billion of IFP. So I post, another tweet below that said, if you're going to $10 billion of IFP, and if you do the math on that, you have, say, $10 billion of IFP divided by $4 million per person. That leaves you with around 2,500 people they're expecting by the time they scale to $10 billion of IFP. So they're roughly, right now I have it tracked in my model, they're at about 1,260 employees right now, total employees in my Lemonade model, under model row 99, tracking those employees, as well as IFP per employee has been marching upwards. But this would roughly mean they're going to 10x their IFP from about $1 billion to $10 billion, and they're going to double their employees from 1,260-ish to 200 or 2,500. So it gives you a bit of this is key to the little analysis I'm going to do here. Essentially, the assumption I'm going to make is to say, hey, if, let's say, all of their operating expenses, here, let's flip over to here, because there's this nice graph, Lemonade gives us this nice summary. It says, hey, IFP versus operating expenses, excluding the growth spend part of it. So all of your operating expenses, except for your growth spend, that's been completely flat for the last several years, all while IFP went from 600 to over $1 billion. But essentially they're saying, hey, at this stage of the game, from Q3 2022 to Q1 now, we've been spending around $89 million per quarter in all the other operating expenses. If we flip to my model, look at total employees from Q3, I don't have the exact number there, but they were around 1,300, and then they dipped, actually dropped some around to 1,200. So the employee count's been relatively stable across that range of time, which makes sense. Essentially, what I'm going to assume is that the operating expenses, excluding growth spend, is proportional to the employee count. So that's not going to be a perfect assumption, of course, but I think it's a decent assumption for a quick and simple model to say, hey, if they, going back to my tweet, if they double their employee count, that probably means they're going to roughly double their operating expenses, excluding growth spend. Okay, but then flipping over to my model here, and I have a tab under the side math tab, which I've done various random little side equations and mathematics to illustrate different things. I have a tiny little simple model here. It says, hey, if you get to 10 billion of IFP, say some point in the future, it's 8-9 years out, whatever it is, and say their employees double. Say they do exactly what they show here, where they go from 10 billion, with 10x the top line, double the employee count. You get 2,500, and say all your operating expenses, excluding the growth spend, is per employee is, say, $283,000 per employee, and I get that by taking your 89 million per quarter times by 4 to annualize it, divided by your current employee count. That gets you to around 283,000 per employee. If you then if your employees double, now instead of 89 times 4, 356 million per quarter or per year they're going to be spending about double that, so around 700 million. And then I say there's a Say there's a 75% loss ratio. Say their gross profit is then 2.5 billion on your 10 billion with your 75% loss ratio. And then you say EBIT-CAC. So I'll say your profitability before you to factor in the CAC is going to be just your gross profit minus your figure here. So it gets you about 1,800 or 1.8 billion. And then I'm saying churn. I could use annual dollar retention because the book's going to be kind of still cross-selling upwards, but just using a simple, I've calculated churn in my model previously, and it's been fairly leveled around 16.5% for the last while. So say 16.5% of your premium just churns away. But then also look at, say they get, that's my dog in the background, then say their customer acquisition spend to IFP conversion is around 2.5. We've been tracking that within our model. It's in the Lemonade model here on line 45 under the model tab, the CAC spend to IFP acquired. And I also have it trying to exclude cross sells, another way to look at it. But in this case, I'm just simply looking at the total. And it's around, it's been 2.75, as high as 4, 3. Management has told us in the past it's been around 3. So I think depends, they're spending more on growth, but maybe we'll play with the numbers here some, but I'm putting in 2.5 as that conversion right now. So then based on that, you can see that your IFP from churn is going to be about 1.6 billion. That's just simply your top line, all your book of business IFP times by the amount that's churning away each year. So you get 1.6, and then you figure out, hey, if we're going to reach a steady state business that's not growing, not shrinking, if we have to just grow to regain that premium and those customers that churned away, you'd spend this 1.6 billion divided by your conversion rate, so 2.5. In that case, you get to about, you're spending, in other words, you're spending about 660 million just to offset all the customers that are churning away each year. And then if you figure out your EBITDA, in other words, what we had above your EBITDA before EBIT-CAC minus minus your replacement cost there, so you factor that in, or you could think about your gross profit with all your operating expenses subtracted out, you're getting about a 1.1 billion of profit. And say their shares grow or dilute to about 82 million shares, you're getting about $14 of profit per share, and your price to EBITDA say is $30, whatever multiple. I know I had 50 in there, but you could put whatever multiple you want. Say it's 30, then you have a share price, about $415. And if they do what I think they do, and they 10x their book of business, that's like 8-9 years out. You're talking kind of 2033, something like that, somewhere around that range. You could argue share price should be 415. You want to be more bullish, and you say, yeah, there's still going to be this rock solid company that's still only 10 billion and growing so fast, and the market's going to say they're worth 50. Well, you could say it's worth $600-700 a share. If you're saying more conservative and the market says, yeah, it's worth 20, well, you're still that's still phenomenal return over where we are now, and it might be 200s, high 200s somewhere in that range. I'll move it back to just 30 for this illustration here. And then you play with some of the other inputs. Like in some ways, just to look at it again, in some ways, this 283,000, I don't know if that will exactly double if your employee count doubled, because you'd think there's other sort of costs, of course. It's not like every employee gets a salary of 283,000, of course not. But there's other costs that would be, think somewhat fixed within those costs, like say a building that you're paying for. And if you add more people inside that building, you can add it up to a certain point without having to lease another building, those kind of things. So in some ways, this is a bit conservative. In other ways, you could argue, well, maybe they're going to have more employees, and maybe this initial chart here is way too optimistic, and instead of 4 million ahead, they get to 3 million ahead, right? And so you have 10 billion divided by 3, you have 3,300 employees. Flip back to my model, so you maybe say 33. Let's just call it like that, 33. Well, your operating expenses go up, but you're still, at a 30x multiple of that, you're still, $329, 20x, you're still 200 and something plus. And that would be the more, that's saying they only get to, maybe this 2 million ahead now, or 3 million ahead, sorry, it was. But maybe you think this is too high, so you could say this is only going to be $200,000 per employee as your employee cost. Well, now you're rising your share price now. That sort of offsets it versus what we had estimated here based on the data we at least have. So I'm going to move this one back, though, kind of back to where we think that could be. Now, if you say the loss ratio is 70%, they get a better loss ratio. Of course, that pumps that up. Maybe the employees are 3,000, but the loss ratio overall is better. Well, you're still worth, $500 a share. Maybe you think churn is going to go up a little bit, or down a wee bit. It makes a little bit of a difference. Big one actually might be your conversion here. We could play with that. So let's move churn back to like 16.5%. Let's say move this back to 75%, and then move this back to 2,500, back to where we were. And then you say your conversion, it's like, because maybe you're spending way more, like the conversion is going to be a function of, hey, we're spending, conversion. Your effectiveness of your marketing spend is purely going to be, hey, how many products do we have in how many markets, and how well are we doing in being creative with our advertising dollars and spend. So all those sort of, it's as you think, as they expand and grow, they're going to have car in more markets, more available at correct pricing, correct loss ratios, correct risk identification, and so you can profitably convert and sell those products and offer the best drivers, the best prices, and effectively convert. So I don't think 2.5 overall is a crazy number, but say we did drop that to 2. Well, now your cost to replace here goes to 825 million versus 660 million like it was, and so your profits go down, and of course your relative share price goes down. But say this even goes to 1.5, you're still could be even profitable, even if it was much weaker sort of marketing conversion. Of course, it's not nearly as great, but it's still could be profitable. I'll just move that back to 2.5. And yeah, shares, that's, I don't know, you could say, well, maybe you have 85 million shares instead, or they dilute, but you could, those are sort of small differences. The biggest factors, probably a big one, is here, the efficiency per employee and how many employees you have, of course, in this model, and of course, loss ratio too. All those the smaller ones you can kind of, I think, are less important to focus on, maybe, are the exact share count. But it's an interesting little model. You can play with this, and I think what's interesting is because it's hard to project what the operating expenses might be. It's hard to sort of quantify what those operating expenses might be, as a whole, right? So what this does is says, hey, look, you might be spending $700 million in operating expenses. Like say, let's look at a more bearish take. Say there's 4,000 employees. I just don't think this is going to happen, though. I think they'll be able to 10x their business. You look at how automated they are. But this is probably way too high, especially if you have more and more employees. So maybe this is only, let's just say, 200,000. No, you're still making a profit. You're still making $13 a share. It's close to what we had before. Just depends what you input here, right? But I think even the sort of standard here is a pretty decent little model. 10 billion, 2,500, it doubles employees. Your overall OpEx minus CAC just purely doubles. And loss ratio is something, within the range of what they've suggested, and you have gross profit down and on and on. So, it's good news. I think it's very positive, and it's a real simple, easy kind of mental framework. All right, so I just made a quick edit adjustment to the little model here. I added in another thing to consider. We can think about it is their IFP growth. So I'm saying IFP from churning, and then IFP you want to grow. So you say you're at 10 billion, but you want to grow 20%. You want to grow 2 billion more. You can put 2 billion in there. Or if you're a purely steady state business with 10 billion, you say, oh, you're at 0. And I have a customer acquisition to replace churn, so that's that one. But then customer acquisition cost to replace growth. So that's how much you're growing. And right now, of course, you're not spending anything there. And then a total customer acquisition growth spend cost. But say you're at this state and you get a PE of whatever it is, 10, and you say you're worth $138. I think this is too conservative with all the inputs we have. But say it's worth 200 or 20, 200, high 200s, whatever it is. And say you want to grow this. Say they're saying, we're going to grow 20% a year. So we put in $2 billion of IFP you're going to grow in that year. Then you could say your growth, you're spending $660 million on replacing what churned, but you're also spending about $800 million to grow $2 billion more. So you're spending a lot more. Your earnings are going to go down. Your earnings per share are going to go down. But then you got to think, well, maybe the market says, they're going to become more efficient. They're going to be they're still growing significantly, and they say, they're actually worth like a 65 multiple, and then you can say, well, the share price is somewhere in the mid 200s by that range, or maybe it's like, it's actually worth more because they're worth $80 or 80 times your earnings there. So there's just a ton of different ways you can play with this. Feel free to play with it yourself. I think if I had to maybe play with this, I might say, maybe employees go to 3,000, but maybe the loss ratios are just better. Like they're more like 70%, and churn, maybe gets slightly better to 16. Maybe this is at 2.5. Maybe they're still growing at 20% per year. Shares are there, and then because they're growing 20% per year, the market says they're worth 50x multiple because they're going to continue to improve their profit margins and continue to grow the top line 20%. So their earnings will grow even faster than that. And and then maybe you say, share price is again 400. So just lots of thoughts there. But thank you so much for watching and for your support. And remember, it's in the bag.